How's it going, everyone? Welcome back to the Invest in Wealth channel. Today's video, we're going to be doing a portfolio review. We're also going to be looking at one stock I did add to my portfolio. It is a new position. We're also going to be doing a deep dive on one international ETF that I am buying up quite frequently in my portfolio, trying to make this new ETF a core holding. We're going to be doing a complete deep dive on that. We're also going to be taking a look at the returns on my accounts in the last week or so. So let's just jump right into it. Portfolio is sitting at just under 188,000. We are up 25.6% all time, or 38,000. Started this portfolio back in 2020. Taking a look at our tax-free savings account. In the last week, it has been a good week. We are up 2%, or just under $900. In the RRSP account, in the last week, we are up 2.4%, or $300. Taking a look at the first home savings account, in the last week, we are up 1%, or $189. And in the large non-registered account, which is my biggest account, in the last week, we are up 1.6%, or $1,700. And going back here in the last month in my overall portfolio has been a great month for us. We are up 4.5%, or 8,000. So let's talk about the new holding I have added to my portfolio here. It is ATD. I've had my eye on this for a while now, probably about a year and a half. I've just never pulled the trigger to buy it. It has pulled back from its 52-week high here from February. I see lots of value here. For those of you who do not know, ATD is a convenience store. They sell fuel, lottery tickets, food, merchandise, things of that nature. They are in 24 countries. They have 17,000 locations globally. They do have a small dividend yield, which that they have grown 23% annually over the last 10 years. I really like the valuation here on this pullback. Last 3 months, they're down about 8%. Didn't buy too many shares. I'm just kind of testing the waters with this one, seeing if it'll pull back a little bit more. But my target for this position, hopefully to get around about $4,000 in this, make it about 2% of my portfolio. I'm getting lots of dividends next month from our big positions like Enbridge, TXF. So those dividends will probably mostly be going towards building up my position in ATD. Let's talk a little bit about diversification and how important that actually is for your portfolio. So diversification, it's not just about sector allocation, it's also about where your funds are globally. To have your funds all, say, in the Canadian market or all in the US market, that's still not really diversifying. You're still not really mitigating the risk. Part of my portfolio, I was previously mainly in the Canadian market. I've been slowly shifting away and building up my positions in the US market, as you can see with my position of VFV, which I'm still currently building on, and my position in TXF, which is the 25 largest tech companies in the States, in the USA. So the importance of diversification, it's not just in the sectors. Like, give you an example, if you're heavy on the tech sector, if you only hold bank stocks, etc., things of that nature. So I am buying a couple ETFs here that are outside of North America. So I do have this one, XEC. So this one is emerging markets, and another one, XFH, which is another global fund. So we are going to be doing a deep dive on this one. We're going to hop on to another screen here and kind of give you the sector allocation and where XFH actually invests for the geography. So ideally, I would like my international exposure to be about 10 to 15% of my exposure, and I am splitting that up between this ETF and the other ETF, XEC. Let's take a look at this one for today. So this one is XFH. This is the iShares Core MSCI EAFE index, and this is Canadian hedged. I do find the performance of the Canadian hedged ETF of XFH, it does outperform the other one. So that's why I went with the Canadian hedged. So what is XFH? International portfolio diversification while eliminating the currency risk. It's a low-cost, simple way to own over 1,500 stocks from Europe, Asia, and Australia. It is designed to be a long-term core holding as well. So let's just take a look at the facts here. So number of underlying holdings, 2,851. They started this fund February 10th, 2015. So that is something you want to look at. Kind of the track record of the fund and the returns when you are looking at an ETF. They do pay a dividend. It's a decent dividend, 2.6%. They pay that semi-annually, so that means twice a year. And we're gonna scroll down here. MER, also a very important thing to look at when you are deciding if you want to invest in an ETF. So that is the management expense ratio. So it is 0.22. I do find that on the lower side, so I don't mind the paying 0.22. This is a very diversified fund. Let's take a look at the aggregate underlying holdings. So just a plethora of different holdings. There are thousands in this ETF. So we're not going to go through every single one of them, but this is the top 10 here if you'd like to see. We're going to take a look at the sector breakdown. So financials, that's the heaviest sector that they invest in. And then it goes industrials, healthcare. So you get all the breakdown there, very diversified. I do like this fund as well because they are heavier in the industrials and healthcare consumer discretionary side, which my portfolio is lacking exposure in. Let's take a look at the geography breakdown here. So this is actually where your money is going, into which countries. So Japan, UK, France, Swiss, Germany. You get exposure to so many different countries. So it just brings out a bunch of different diversification strategies. It is very, very important not to just be invested in one country. We do call that home bias. So say you lived in Canada and you only hold Canadian stocks, that is called home bias. Really, when you're investing, you do want to allocate your funds to whole different types of countries. That just kind of eliminates your risk, and it also brings your portfolio way diversified. All right, moving along to my first home savings account. For those of you guys who are not familiar with this account, it is like an RSP and a tax-free that is put together. But all the funds, when you withdraw, they have to be used to be going down for your first home. So this account, you get $8,000 worth of contribution room a year, up to $40,000. So I've put in $8,000 last year, and I have already put in my $8,000 for this year. So the contribution I made last year, I got about $2,200 extra on my tax return just for doing the contribution, which is a great benefit to this plan. I am taking a bit of an aggressive strategy here with this account. I don't recommend you being aggressive in this account just because it is for your down payment on your house. You obviously do not want to lose that. In my case, this is a very small portion of my portfolio. I mainly just use this account for the tax write-off. Also, in this account, all the money you make is tax-free. So as you can see, I am up $2,312, and all that is tax-free. This is a fantastic account. I do recommend you guys open one up. Just be mindful of your time horizon with selecting some of your funds. Like I kind of strayed off from that just because, like I said, this account, not really too concerned about the returns I make on it. I'm more concerned about getting that nice tax write-off at the end of the year. Let's speak a little bit about my non-registered account. My non-registered account has a great mix of dividend stocks and growth stocks. For you guys, you generally want to be holding stocks that pay dividends in registered accounts, just because if you do receive a dividend in a non-registered account, you have to claim that as 100% of your income. So say you got a dividend for $50 in this account, you do have to claim $50 as taxable income for that year. So generally, you do want to hold growth stocks in non-registered, just because that capital gains tax, so say again on that same $50, if that was a capital gain, you only have to pay tax on the 25. So just a little tip for you, for those of you who do have non-registered accounts, you always want to hold generally your growth stocks in the non-registered and then your dividend stocks in the registered. All right, that pretty much sums up for what I wanted to talk about today. Hopefully you guys learned something new and took a little bit of value away from this video. I do enjoy kind of mixing it up and talking about different things and not just going over my holdings in my portfolio. But other than that, hope you guys enjoy your day. Make sure you like and subscribe, and I'll see you in the next video. Thanks. Bye.